Andrew Holland is joining in right now. Andrew, thanks very much for taking out the time and speaking with us. Uh, I, I don't know whether things have materially changed, but there are some telltale signs that, and in comments that are coming out, where there is a possibility of, the numbers of coronavirus peaking out in the US by next week. That's what Anthony Fauci has indicated. You've got some of the countries back into a bull market territory. Europe, Germany, within the Asian and the emerging market basket pack, you've got South Korea, you've got Philippines. US itself, the S&P 500 itself has moved up 20% from its lows. Do you think things are changing, or this could just end up being, that really strong bear market rally?
Yes, it could well be, because everyone's trying to work out where the bottom is. But let's just take your point, which is a very good point. Is that, see, first of all, we have to get the flattening of the virus curve, and that's what the first stage is. Now people are starting to look beyond that, and the narrative changes about when countries and companies can start going back to work. And I think that's where I think the problems might really come out. Is that, first of all, it's going to be in a phased manner. It's not just going to be open up and everyone can go back to work, because there's still a lot of problems and cases in Europe and the US. Secondly, is that, are we going to change our habits so quickly? Unless there's a vaccine, I still think people are going to not spend as much, yes, on essentials and maybe some other goods. But I don't think, you're going to be wanting to go out into public spaces where there's many, many people. So I think it's going to be not a V-shaped recovery. You will get a little bounce, obviously, initially when people can actually get out of the house. But thereafter, I think it's going to be a U-curve in terms of the recovery, and that's going to be painful. And I don't think the market's baking that point in yet. So let's look at it. The US has given $2 trillion package. That's 10% of GDP. And everyone's saying that second quarter GDP is likely to be anywhere between 20 to 30% down. So they'll have to give more packages. So the problem remains is that, yes, for the next 3 months you might be okay, but what happens after that? The cash flow problems for small and medium-sized businesses just don't go away. And I think that's really what the market will have to start baking in at some point. So yeah, you will have rallies, and I think this is a little bit, to my mind, like 2008. You get trading opportunities both on the upside and the downside. But fundamentally, I don't think you can really say, we know where the numbers are, and that's going to take some time.
Okay, so can you make? I know it's a forward-looking statement, but we have all the data points in hand. You've got the possibility of a big cut in GDP. We've got Goldman Sachs placing India's GDP at 1.6%, some saying 2%. So that's a big sharp knock that we are expecting. Globally as well, economic growth is going to be extremely slow. In light of all of these factors, excitement around such bear market rallies, are they warranted, or does one just sit back, hold on to some amount of cash when there is something that you can put a finger on and say, okay, now I know for sure things are changing, that's the time I start investing?
I think that would be a good strategy, because what you have basically is that forecasts are all over the place. So until we start to see countries and companies getting back to work, and how quickly they can build up capacity, and then the demand. So let me give you an idea of I was kind of saying that there's a V-shape or U-shape recovery. So a German institute came out yesterday and said, we expect GDP to fall by nearly 10% in Germany, and then recover. So by the end of the year, it's down by -4. And then in terms of what they're saying for 2021 is that there's a recovery of 5%. So basically, you've got 2 years of flat growth, even if you take that U-shaped recovery. So that's going to be very painful for industries. So until we get to the point where we can start seeing what the demand is like, then we can start looking at fundamentals of where we think companies will be, where industries will be, and what the right kind of PE ratios or price to book ratios we should be looking at. So until then, I think sitting on the sidelines is probably just a safe thing to do. I don't think there's any reason to get so optimistic, unless obviously a vaccine comes along and that would change the whole picture again, but that's not likely till 2021.
Andrew, good morning, Neeraj here. What are you doing currently? I mean, how is it that you are taking a bet, whichever way, or are you just sitting on the sidelines right now? Because I presume you guys you were sitting on a bit of cash ahead of this crisis breaking out.
No, and we're still continuing to do that. As I said, that we'll use that experience from 2008 to look for trading opportunities. And what will happen is that you'll get a whole host of things happening. So coronavirus cases starting to kind of flatten, which gets you to the next narrative, which is kind of positive. The oil price, a potential deal with OPEC today, which is positive. But then what after is you look at and say, well, fundamentally, how will that change things? It doesn't change anything in terms of the damage that's being done to the economy and to particularly small and medium-sized businesses. I want to emphasize that this is all about cash flow. If you don't have any cash flow, it doesn't matter how low your interest rates are. If you can't pay your debt, you can't pay your debt. So there's still that problem to go through the banking industry. Now, the Fed and the Bank of England have done a backstop. I think here in India, we need to do something of the same, because whilst the RBI has done well in terms of providing liquidity, where are banks going to lend this? I mean, it's all about working capital loans, and it's about whether they want to take on those loans potentially, which could become a non-performing loan. So either you've got to have a bad bank, or you've got to backstop some of these new loans going forward, so that the banks will feel secure in lending.
The leadership, if I can call it that, within private financials has changed quite dramatically, Andrew. Do you reckon that consumer lending and even banks with a higher proportion of consumer lending would be the lesser favorites now, or are valuations pricing that in for either a pure consumer lending business or these banks which have got a higher proportion of consumer lending?
I don't think it's the time. I mean, yes, you're right in that terms of consumer lending is obviously going to be, a slow pickup, and there could be obviously, if you listen to what Bajaj said in terms of their customers, they're going to take some time to pay back. So you can start putting another quarter away from where we are today, not for the next one quarter, but the quarter after, before you start to see resumption of EMIs being starting to be paid back. So I don't think there's going to be a rush to take out loans in the very short term. So I think you've got 6 months of pain for the banking industry in terms of growth, and that's why I'm saying if you really want to, if and when we come out of this and the lockdown starts to be alleviated, it's where are you going? How are companies going to start up? They need working capital, and I think this is going to be the key. I'm sure the RBI and the government are well aware of this, so they will come out with the necessary packages. But the longer they leave this, the more stress that's going to be on the banking industry.
Andrew, what's your take on the hotspot right now, which is pharma? Everything seems to be going right for this particular space. But is there more that meets the eye than just what you get in terms of market entry, fast approvals for the US markets, and to get in drugs like hydrochloroquine right now, which is getting under trials in the US market as a solution for COVID-19? Is there more that one needs to watch out for from this particular space?
Well, so very fortunately, we became bullish on this sector, back end of last year. So I would say back end, it's more about September, October. I think obviously Bernie Sanders kind of going out of the race is a huge relief for the generic players. So it's an extra kind of move for the share prices today on that, because he was obviously wasn't favourable towards generic companies. But even if you go back to 2008, 2009, the two best performing sectors around that time were both pharma and staples. So, there's no real change in that. You go to safety. But coming out, once we come out of this, then obviously this will be used as the areas where you've made some money to go to the other sectors which will then start to perform as the economy starts to move forward. So that's the usual pattern. So I don't think there's anything unusual about it. It's just been a very beaten down sector where there's probably underweightage by many fund managers, and they're just getting back to try and get equal weight there. And obviously, the good news is was never thought about for the sector for many years now. So this has been a shot in the arm for them. And obviously, if they can continue to build upon this, which they should, I think the big difference this time around, maybe coming out of this lockdown, would be that I think all of us, and I'm saying, well, I would probably anyway. I think one of the things that I'm going to spend more money on, or probably put more disposable income, is towards health. And I think that will be a new theme going forward across the board. So not just in India, but I think globally. So maybe there's an extra leg of growth. Now it's really up to these companies to try and really take the initiative and be ready for that growth when it comes. Because that will be very good for a lot of the generic companies, which has been that kind of demand has been missing for a long time. So maybe they can get some pricing power as well, which has been they haven't had for many years now.
Actually, so you do see investments coming into some of these safer haven companies and sectors, and then post that, when you actually do see the market moving up full swing and the correction turning around, these are the pockets where you've made your money, you've moved out the money from there and to invest in rather high beta names as well. But so when we do see that happening, and when we do see the base formation, we do see things turning around, where exactly are you seeing the biggest chunk of the leadership coming from?
So, the question, and you've asked the good question, is, have we hit bottom? And the answer is, I don't know. What we're looking for is three factors which would make us feel, that the stability in the market is there for us to look at fundamentals. First would be, and we talked about it before, would be that, the flattening of the curve in terms of new cases globally. Two would be then the narrative moving towards getting back to work and what that would mean. And three, the VIX, the volatility index in the US, was around 80. It's now around 43. If that kind of heads towards 20, then I think, we'd feel more secure that the markets are now baked in a lot of the expectations or the near-term volatility, and you can step back in the market. But thereafter, you have to then see how quickly, and I'm talking about India now, how quickly we're going to start to move towards opening up either states or industries, so they can start producing goods and services, and then how quickly the consumer is going to start spending. I think that's going to be a good 6 to 9 month kind of battle. I think for the consumer to really want to step out and really buy something. Let's not forget that whilst we're all talking about getting back to work, a lot of people will have been either laid off or will still feeling insecure about their jobs going forward. So I think people will tend to save initially. I know we've not been going out, so we've been doing some saving, so we have some extra spending power, which is why I'm saying that initially you might get a peak in spending, then I think we'll start saving and maybe put more disposable income towards more health type issues.
By the way, I just must mark this before I get back to Andrew for the next question. Pharma is on a roll. Banks are on a roll too, but look at Pharma. Cipla, because of that approval, is up 15%. On the back of that, Lupin is up 9% at 769 or thereabouts. And then some of the others are following suit, the likes of GSK, Glenmark. But Cipla has news, and Lupin is a allied beneficiary of that. And as a result of that, that stock too is doing well for itself. But banks are certainly packing in a serious punch in the session today. Andrew, a bit of a negative surprise today came in from IT. I wanted to know what's your sense on whether a depreciating rupee, and if you guys believe at your house that the rupee is slated to go lower, does it have any material impact on IT companies or no? Part one. And part two, the call that happened and the updates that came in from ISG seem to suggest that FY20 or the calendar year 20 would well be a washout year.
I think it's going to be a washout year for a lot of sectors and companies. I mean, I don't think IT's alone, but let's think about this. I mean, you've got a lot of people now, working from home, and whether that will change going forward, don't know. But the unemployment figures, Europe, US, are huge. So, maybe a lot of these people will find employment in the IT sector in their respective countries. Therefore, outsourcing, might be under pressure. In terms of, as an industry. I think what will happen in between time is because of that pressure, then IT companies will have to lower prices, or they have to renegotiate contracts, which will be a lot lower than we see today. So I think, they don't have any pricing power anymore. They haven't had for many years now. So I think that's where the problem is going to be for the IT companies. So whilst it's been normally a safe haven, in the past, I don't think you can say that anymore, and I think it's going to go through another kind of year of turmoil as they try and renegotiate contracts and margins become lower, and the competition, obviously, from maybe lower cost workers in respective countries who can take on the work. So I think that's going to haunt the sector for the next 6 months.